Let's get another viewpoint on this. Joining us now from the University of Pennsylvania Wharton School, finance professor Jeremy Siegel. It's good to talk to you, Professor. When we're talking about your view of 2019, you think that the market should return between 5% and 15%. How do we get there amid all of this fear and uncertainty that is currently plaguing the market?
Well, I just look at valuation levels. We are selling S&P at 16 times last year's earnings. So that is a cheap level historically. In fact, over the last 65 years, it sold at, on average, over 70. So even if we don't have any earnings growth this year, this is a cheap market, especially. Look at interest rates. Oh, my God, I hardly believe the 10-year at 265. No competition from fixed income. I think we can really have quite a good year in the stock market.
All right, so when we're taking a look at some of the warning signs that investors are paying attention to, the risk of recession, a flattening yield curve, whether we're going to see consumer confidence falling off of these incredibly good levels from 2018, what are you concerned about?
Well, first of all, I'm not concerned about the Fed. With the 10-year at its level that we see now, we're not going to see any increases. If it's below 3%, I think the Fed is really going to defer. I actually think it was a mistake. I don't think they should have raised in December. But nonetheless, I think that we don't have to worry about Fed rate hikes as long as the economy is weak. Now, if the economy picks up, we might get one or two, but then the earnings outlook is going to look a lot better than what we have today. So, overall, what happened is that we went from a pretty rosy view, way too rosy. I had said last year that 2019 earnings were way too high, to now, oh my God, there's going to be a recession. The truth is going to be somewhere in between, and that leaves the stock market, I think, very attractive now.
Do you think it's significant, Jeremy, that for all the hand-wringing all year long about the inverting yield curve, it actually never inverted if you look at the main twos, tens, and for all the hand-wringing about a bear market, the S&P actually never reached a bear market? It got a few points away from that, or does that stuff not matter?
Right. No, that does matter, and the 10-year, what I look at is the 90-day Treasury bill and the 10-year, and it did not invert. It's about 25 basis points, so we're not quite at that critical level, and that's why the Fed cannot afford to go, any higher with the 10-year as it is now. They do take that seriously. We didn't hit a bear market. Will that Christmas Eve low hold? My feeling is it very well might. We might get a little bit of a test on it the first few days of this month, but Christmas Eve, I think, was a pretty gloomy look at what the world outlook is. Even a slowing outlook, I don't think really justifies how low stock prices are.
Jeremy, you've typically been bullish. I can go back a long time, and it's been the right call, by the way. But I wonder, in this environment, or one you could imagine, is there anything that would turn your view to one that would be perhaps a bit less sanguine?
Yeah, well, clearly a recession is going to bring the market down more. I don't see it in the cards, but let's face it, it's a delicate matter for the Federal Reserve. We're going to get the employment report on Friday. Some say it's going to go down to 3.6%. That's a 50-year low. We can't have 150 to 200,000 increase every month unless we get more people feeding into the workforce, which doesn't look likely. So the bottom line is the Fed had to squeeze enough to get us down to around 120,000. Now, do we have that precision? Has the Fed ever engineered a soft landing? Not exactly. There's always been a wobble here, and I think that's exactly what the market feels. We're going to be a wobbling to a slowdown, but not a recession. And until we see that clear, people say, I'm going to be cautious. But if there isn't a recession, I think you've got really great values. Of course, obviously a trade war, but Trump can't afford that now because he knows the stock markets just so early won't look at that favorably, and he does care about the stock market. So some deal is going to be reached on China, we avoid a recession,
Yeah.
we're going to have a really good market.
Jeremy, the Fed rate hikes get all the attention in the headlines. Do you think the fact that they are trimming their balance sheet, unwinding years of stimulus through QE 1, 2, and 3 is having any impact on the markets, either psychologically or mechanically?
Well, the thing is, there are still excess reserves there that can be absorbed. What we will see if the Fed gets too tight in its quantitative tightening, in other words, getting rid of reserves, we will see the Fed funds rate rise above the level that they pay on reserves, which is now 2.40. But that's exactly where the Fed funds rate is now, which means there's all these excess reserves that the banks are putting on deposit at the Fed. If it ever rises above 240, wow, look out. That means they are getting too tight, but I think the Fed is aware of that. They still think there's somewhere around $1 trillion of excess reserves that they could absorb, but they know they can't go beyond that because then they lift it up from the reserve level, and that's tantamount to another tightening of the rate. So they're watching that, but I don't think right now that is a problem for the markets.
And you were talking a little bit about trade there. How big a deal is the trade tension at this point, the standoff with China? Because when the tariffs first were talked about and implemented, there were a lot of experts who poo-pooed the big impact on the American economy. And now in note after note that you see from investment banks and from in articles in the Journal and CNBC.com, you see trade mentioned as a very important factor in what happens in 2019.
Well, certainly, I mean, if we go to 25% on all their products, that is a big thing. Clearly, with the weakening of sentiment and the stock market, those are factors that could precipitate a real slowdown. But, Trump's advisors are going to tell him that. I mean, maybe Peter Navarro's not going to tell him that, but certainly Kudlow is going to tell him that and knows that. And so he knows that he's got to really tread very, very carefully on this. He can't afford, given the markets, to go full scale on that trade war. I just don't think it's possible.
And you have to wonder how much pressure the Chinese leadership is under at the same time, too, with the economy slowing
at the same time,
to get a deal done.
Really, in some ways, the weak data out of China plays more into the Trump scheme of things. They can't afford a big slowdown either. So I think they're both motivated to come to an agreement.
Jeremy Siegel, professor at Wharton. Thank you, sir. Appreciate your insight.
Thank you very much, and Happy New Year.
Happy New Year.